The two most important economic figures released each month are the employment rate and the index of purchasing managers' activity. Here's an assessment of where they stood as of May. The Labor Department reported that on May 6 that U.S. employers added 160,000 jobs in April. It was a smaller increase than the 205,000 jobs expected and the slowest pace of job creation since September. The stock market dropped sharply after the Friday morning announcement, but rebounded by the end of the day. The Standard & Poor's 500 stock index closed up 0.3%, but this was a classic example of how emotional swings occur temporarily in stocks. If you are a long-term investor saving for retirement or relying on a broadly diversified portfolio for retirement income, emotional dips are unlikely to matter. As May 2016 began, the Standard & Poor's 500 stock index was only about 4% off its all-time high. Stocks have been more volatile in recent months, with two double-digit corrections in August 2015 and again in February 2016. More volatility is certainly possible. New job information, the blue line in this chart, has been robust, and the unemployment rate, the black line, is back down to 5% for the first time since April 2008. As the unemployment rate drops to this low level, producing new jobs grows more difficult. The last time unemployment fell below 5%, job formation slowed. You can't form new jobs at as high a rate when almost everyone already has a job. Companies find it increasingly difficult to fill vacant slots, stifling formation of new jobs. In a political year, it is not surprising to hear that the U.S. jobs recovery is anemic, but it isn't so. This is the most recent data from the government on the jobs recovery as of May 2016, as well as two previous recoveries. Job growth has been stronger for longer in this recovery due to the depth of the last recession. But it's wise to expect job information to decline as the unemployment rate sinks further. The May 6 Labor Department report showed a 2.5% rise in average hourly earnings rate since 2015. That's the line in red. That's an acceleration over the 5-year compound annual growth rate of 2.1%. Meanwhile, the black line, inflation, has been flattening. What's that mean? It means the real rate of gains in hourly earnings, the after-inflation rate, is accelerating sharply. While cable TV news and financial channels are filled with smart-sounding people talking about what a big problem wage stagnation poses to the American economy, this chart shows wages after inflation surged after October 2014. Wage stagnation was a problem as recently as 2014. But you can't say wages have been stagnant in May 2016. It's just not true. Finally, the second key monthly release to come out was the Institute of Supply Management survey of purchasing managers for April. This index measures order activity across 90% of the economy, non-manufacturing sectors. Look at the surge that occurred in April. This was a sharp reversal of the previous 2 months of declines. The Institute of Supply Management is best known for its index of manufacturing activity. However, after the U.S. manufacturing economy shrunk and the service economy grew in its influence, ISI created the non-manufacturing index to track what today represents 90% of the economy. While this index has only limited history, it works the same as the widely watched manufacturing index. It is designed to show a reading of less than 50% well before the onset of a recession. In April 2016, the index sprang higher to 55.7% from 54.5% in March. Relative to the 50% demarcation between a growing or shrinking economy, the April non-manufacturing PMI was high and surged higher. Moreover, the new orders component of the index shot higher. Strong new orders bring stronger production and order filling in the months ahead. According to ISM, which is a not-for-profit trade organization, the 55.7% rate in the non-manufacturing PMI is equivalent to a 2.7% compound annual growth rate in the economy. Last quarter, the economy grew by just 0.5%. And a 2.7% growth in the year ahead would be a sharp acceleration, and this bodes well for the economy in the months ahead.